It's the start of a new week, and we have For Pete's Sake and Peter Hug next. We have Kitco Metals Global Trading Director with us, Peter Hug. Peter, thanks for being with us.
You're welcome, Daniela.
And not to harp too much on the past, Peter, but before we look at gold this week, let's take a look back at what we saw last week. Obviously, it was a key week with the FOMC, the ECB. We had unemployment numbers, GDP. Everyone was expecting the market to really react. It didn't up until Thursday night. Can you give us a little bit of a synopsis of what you feel happened?
Well, when the Fed came out on Wednesday and followed by the EU on Thursday, both standing pat on their current policy, that should have been the momentum that the bulls were looking for, and it just did not develop. So you had a situation on Thursday where both the Asians and the Europeans were disappointed. I guess they were expecting that both the Fed would indicate that they may increase their bond purchases, which certainly wasn't on the table, and they may have expected Draghi to drop interest rates, which also I don't think was on the table. But either way, they reacted on a basis of expecting a tightening and sold the market off. And then Friday morning we came in, and the unemployment numbers were a little worse than expected. They certainly weren't disastrous, and the market somehow perceived this to be, well, the Fed's not going to tighten it. It's going to keep current policy, and the market rallied up over 1,300. It was a classic whipsaw. And again, as I mentioned a couple of weeks back, this is the time of year, unless you really have to trade, which unfortunately I do, is a time really to just sort of to sit back and let the market just meander around. In September, we're going to have enough data and other events that will create a trend.
Well, after last week's FOMC meeting, everyone was speaking about how the Fed will definitely taper in September. A, do you agree with this? And B, how important will the FOMC meeting in September be?
No, I don't expect the Fed to begin tapering in September. I think they may in September actually announce a number and say, given where we think the economy may be at the end of the year, we suspect that our bond purchasing program will drop from 85 billion to whatever number. I'm suggesting the number is probably going to be somewhere around 60 billion a month. But again, I do not think that's going to happen at least until October. But I'm still in the camp that tapering will not occur until the new year.
All right, so now let's look at what's happening this week. Peter, I know in your morning commentary you were adamant about the fact of how much you hate summer as a trader. Gold right now is hovering around the 1,300 mark. What are you looking at this week? What's key for you?
I don't like the market, but it's still above 1,300. So you'd have to make the technical argument that it's still constructive here, but it's a garbage market. I mean, that's the best way to describe it. When in my previous life, when I ran a trading desk for a bank, we forced our traders or 80% of our desk to take August off, because August is traditionally just absolutely a dead month. Most of Europe shuts down. The issue with August, unfortunately, the other side of that point is that because it's so thin, you get these exaggerated moves. And I don't think there's any data points that are going to be coming out over the next 2 or 3 weeks that are going to have an impact on the market. If anything, what I'm looking at in the short term, by short term, I mean the month of August, is watching the value of the US dollar. If that strengthens, I think gold is going to come under pressure. If it weakens, I think the reverse will happen. But I'm also looking very closely at the geopolitical events that may occur in August, given what the US government just issued as a warning on Friday. If events in the Middle East or anywhere in the world suggest an attack, or if an attack happens, with this thin market, gold could easily run $50, $60 and still not, to me, confirm a trend.
It's a garbage market, Peter. That's on the record. Now, looking at silver, HSBC coming out with a trading range today for the metal, looking at $17 to $23 silver from now until the rest of the year. Seems like quite a big range, though, for silver, right, Peter?
I mean, I'd love to work for a bank and pull down six figures and be able to come up with a forecast that is $6 wide with 4 months left in the trading year. I mean, I'd be embarrassed to publish that. $17 to $23. I mean, really, if you take that seriously, I just don't. It's a joke. I think silver will trade with gold, but I think $17, $18 is a possibility, and 22 on the upside is a possibility throughout the rest of this year. I'm still leaning for softness in the short term, but with a rally coming into year end, into the fourth quarter.
Right. So if you come out with a range, it shouldn't be a $6 range for silver.
Well, I mean, $6. I would be embarrassed to publish that, but again, I'm not a banker, and so anyway, enough said.
And we're lucky you're not a banker, Peter.
Yeah, sure. Thanks a lot.
And thanks for watching For Pete's Sake this week. You can email us at newsfeedback@kitco.com or follow me on Twitter @Daniela Cambone. Thanks for watching.